Well, how's it going, friends and family? My name is Amos, and in this video, we're going to be evaluating and grading the Mag 7 and other popular stocks against one another. And the question that we're trying to answer with each business is this: are they a dividend compounder with cheese? And you can go ahead and call me crazy, but not every stock is going to be in that S tier level. And in order to reach a conclusion for each one of these companies, there's a lot. There's over 15 of them. I went ahead and applied the following metrics. Number one, I took a look at their financials year over year, forward looking, not just at the past, but what is the trend and direction this company is going right now. The revenue year over year, the earnings per share, the free cash flow per share, and of course, their debt to EBITDA ratio. And then number two, I took a look at their dividend profile. If they don't pay a dividend, of course, I'm going to take away a little brownie points, but if they're crushing it in all of their metrics, I think it more than makes up for that fact. And then number three is their past performance, their total return. And to do that, for the most part, I used the 20-year CAGR. That's the compound annual growth rate. When you take into account the share price appreciation plus the dividends paid out, how much did this investment grow year over year? And just as I alluded with the financials, the CAGR is what they achieved in the past, but I'm more of a forward, future-looking kind of guy. What are they going to do in the future? Are they going to continue to dominate or go on a massive sell-off? What good is it for them to have a 30% CAGR up until 2025, only for them to go into the negative in 2026 or 2027? So the CAGR only tells a part of this story. The people that put all of their eggs in that basket and say it's only about the total return, that or nothing else, I'm like, dude, you're being short-sighted. I think the financials, the fundamentals, and everything else needs to be in order as well and be growing in the right direction and trend, up and to the right. If you only look at the total return, I don't think you're doing this right. And of course, the last metric is going to be their economic moat status. Do they have one? Is it certain? Is it 100% foolproof? Or are there a lot of competitors? Are they losing market share? So those are the four metrics that I applied to evaluate and grade each company. Now listen, I tend to go pretty darn deep into the numbers and financials for almost every single one of my videos. However, for this one, it's going to be different and straight to the point. However, if you do want a full explanation and walkthrough of how each company ended up with their final grade, then make sure that you subscribe to this YouTube channel, the Dividend Compounders with Cheese. I'm Amos, the Dividend Guy. That way in the future, you don't miss that upload. Because right after I finish filming this video, I'm going to do that deep dive video and go over my personal buy price for each company, but also their intrinsic valuation as well. So if you care about the nerdy numbers and the data, then watch that one as well. With that out of the way, let's go ahead and get into it. The first company is going to be Apple. Okay. Now, Wall Street, as of right now, they're a bit bearish towards them because of the whole tariff situation and how they manufacture their entire catalog and inventory of products overseas. It's not going to be a fun game for them if this tariff situation gets worse. And their financials, when I took a look at it, it's stalling. Right? Instead of posting double-digit growth numbers across the board, they're now growing at a very sluggish pace, very similar to a CPG company or even a retailer. And this is a tech company we're talking about, right? And as a result, there's a lot of people that are selling out of Apple. You know, they're saying like the best days are behind them. Their future looks dark and it's fearful and it's ugly and it's messy and it's hairy. But to that, I say this, as a shareholder, I think Apple's domination and their current economic moat should not be dismissed so easily. So to start out the video, I think Apple is what constitutes and defines an A-tier stock and as a business. I think A-. I think 4 years ago, they were absolutely in the S tier. But as of right now in 2025, with all of their headwinds and everything else that's going on with them, I think Apple is flirting with being downgraded to the B tier, to almost being a B+. But let's just go ahead and say they're A-. And the reason being is that unless they find a way to increase their numbers, I think in the future, if I do this video again, if this gets enough views or demand from the people, because I listen to the people, by the way, if you comment on my videos, I read them, I respond, and I make my videos based on what the people want, they could end up being here next time around. But as of right now, I do think they're A-. Now moving on to the next company, it's going to be NVIDIA. Now the bottom line up front when it comes to NVIDIA is that when it comes to their CUDA framework, which is their proprietary patent, the AI movement is predicated and is very dependent on that. So that is why NVIDIA is absolutely successful right now and is crushing it across the board. And believe it or not, their balance sheet and financials look absolutely ridiculous. And depending on your age demographic, you might be like, what? And I say that in a good way and as a compliment. It is ridiculous because it is growing almost at a triple-digit rate year over year, sometimes over 150%. And their hyper growth story is almost comical because I invested into NVIDIA back in 2018 only because of their graphic cards in PC gaming. I was like, you know what? I think this company sounds interesting. And that's before I started to learn how to really do a deep dive into financials. And even back then, I was just like, I like this company. I invested into them. And I'm not going to sit here and lie to your face and say I predicted them to be the giant that they are today. I had no idea. But needless to say, once I had a 100% return on investment with NVIDIA, I sold out of them. Little did I know, if I had just held on to them, I would have 10x'd my money. However, based on their current situation and the numbers on these 4 metrics right here, I definitely think that NVIDIA is in the S- or A+ grade mark. And to be honest with you, I think they would be S+++ if it weren't for the tariff wars and NVIDIA not being allowed to export to Chinese companies for a bigger gross revenue. And because of that, I think as a ramification, the Chinese chip companies are going to go all out in trying to make their own semiconductor chips by reverse engineering the NVIDIA ones. And the R&D team in China right now, they're going into overdrive to emulate what NVIDIA is doing. And so because of all of those factors that I'm considering, they're not a perfect S, but they're S-. Now, the next company is going to be Microsoft. I think Microsoft is one of the few companies where I really don't need to give an introduction for. And when I think about their products and offerings, I'm not really bullish towards their Office products because that's what most people associate them with. However, I am actually bullish towards their Azure cloud endeavors. But they're not just a cloud-based company. They also have LinkedIn, which is a professional social media network that a lot of employers and recruiters utilize. They pay for the premium account. That way they can message people nonstop and to find talent or to network or to figure out, do I want to jump ship and go to this company or not? So LinkedIn is also there, but they also have a gaming division with Microsoft Xbox, but they also acquired Blizzard. Now, as a kid that grew up in the 90s, I actually used to play Diablo and StarCraft. What I'm trying to say is, right now I might be bullish towards their cloud endeavors, but if they can tap into their magic again and create something new, instead of doing a relaunch and a sequel to the ones they already have in their database, to create something new, that magical experience similar to like Warcraft, Diablo, or even StarCraft, I'm talking about something in the territory of like the Grand Theft Auto series, but not that type of graphics and gameplay, but like an MMO or a role-playing game. I think that's huge for them. That's a catalyst, I think. And I don't say this lightly, but I think Microsoft is easily one of the best stock recommendations for beginners and veterans of the stock market alike because it's so reliable, stable, and it's very high quality. Their balance sheet and their credit rating rivals that of Johnson & Johnson. I think those are the only two companies with like a perfect credit score. All that said, I definitely think Microsoft is in the A tier alongside with Apple. Let me just make them a little bit smaller. They're not an A+ or A-, they're just perfectly an A. Whereas Apple is somewhere like right here. Okay, we'll just put them in between. That way we can distinguish the difference between the two. And the next company is Amazon, ticker symbol AMZN. They started out as a company that used to sell used books out of a car garage and then out of a warehouse, but now they evolved into becoming a huge behemoth conglomerate. Now, some people love Amazon and other people absolutely despise and hate Amazon. I remember a few years ago, Amazon was deciding to open up a second headquarters on the East Coast, and they settled on New York City. And my goodness, the residents of New York City protested so freaking hard that Amazon had to backpedal and go against that decision. And instead, they opened up their second headquarters down in Nova, Northern Virginia. So they remind me of a modern day GE. They got their hands on a little bit of everything. I'm talking about e-commerce, Prime Video, AWS, and even advertising. You know how when you search for something on Amazon, like say you're looking for polarized sunglasses because you're trying to run a marathon for like the 20th time, but you keep quitting because every single year you're like, oh, I'm gonna run a marathon, but you end up never doing it? Sorry, that's my story. This year, I'm really trying to run a marathon, and I've been always coming up with the stupidest excuses on why I can't do it. But anyways, I've been shopping for sunglasses on Amazon. No matter what it is that you type into the query, you always get like a row of 5 or 10 or 20 sponsored products before you actually get to see what it is that you're looking for. So advertisements is their newest segment that people are pretty bullish about. But as for my personal take, I think I'm most bullish towards their pharmacy endeavors, as I think it's going to be a game changer. When we think about the antique models of like Rite Aid or Walgreens, dude, they're cooked. They're absolutely done for. Now, even though Amazon does not pay a dividend, I think in lieu of it, they're making good use of their excess cash on hand by returning value to the shareholders through growing the company very aggressively and doing a lot of CapEx. Now, me personally, based on what I just said, you might be like, so you're a fan of Amazon, right? I actually don't like Amazon as a company for the way that they treat their workers, all the way from the top down to the bottom. Fulfillment center workers, all the way to the ones that are sitting in their offices in Seattle. Everyone gets treated poorly, and it's a very stressful work culture. But as a stock in a business, I cannot deny they're absolutely amazing. So with that said, I think Amazon is an S caliber. They are S tier. If I were to open up a textbook and look for what is an S grade type of stock or a business, it would be Amazon. By the way, I'm reading The Name of the Wind by Patrick Rothfuss. 10 out of 10 would recommend. If you're trying to get back into reading, or if you already read books and you need a recommendation, this is the one. Now, the next company is going to be Tesla. Elon Musk's Tesla. They do EVs and they also do solar panels and a whole bunch of other stuff. Now, Elon Musk's disruption in the EV space, I definitely think it was worthy of headlines back in 2020, 2021. However, since then, every single automaker except like Toyota and Honda, I don't know why the Japanese automakers are so resistant towards going into the EV movement. But anyways, that's for a topic of its own. Every automaker, including Chinese car companies, are catching up to Tesla. And not only that, I think Tesla's stock price is really sensitive to Elon Musk's relationship with Trump, more so than the actual numbers that they post. As a matter of fact, they just had like a public argument on Twitter or whatever, and as a result, like Tesla went on a sell-off. And when I see stuff like that, I'm like, I'm not a big fan of that. And because of that, I'm not in particular bullish about Tesla as others are, and also based on their financials that I'm seeing. And to go against the idea of operating in an echo chamber, I did go out of my way to look for arguments that are bullish for Tesla. I just don't believe in it because their actual objective data and numbers are slightly above average. There's nothing that I see that is worthy of bragging about or to go crazy over, like Amazon or Microsoft. If you look at their numbers side by side, completely different. So as a result, I definitely think Tesla is a good company, but I just definitely don't think they're S tier like some people are delusional and believe them to be. I also don't think they're A. I think they're slightly below that. I would argue they're in the B minus tier. Oh my gosh, I had to make this logo so freaking small, but I think they're a B minus, C plus type of company. I'm not bullish towards the car industry, and especially towards EVs like other people might be with like Lucid, Rivian, and everything. When I think about the operational overhead costs, and I think about like Ford, GM, and I look at their business model for like the past 20, 30, 40 years, the margins are razor thin, and I just don't believe in the future of that industry. And you absolutely have the right to disagree with me depending on where you live, especially if you live in a country with free speech, but yeah, I'm not bullish towards Tesla. All right, friends and family, so the next company is going to be Alphabet, more commonly known as Google. Now, this is is the parent company of Waymo, the AI movement, YouTube, where you're watching this right now, Android, Google Cloud, Google Workspace, and more. When I think about their economic moat, it's as wide as it gets because their main mode of business, what makes up a majority and a bulk of their revenue, the advertising and search line business, in fact, they make so much money from that operation that they even have a side hustle known as Other Bets, where they just create new businesses that have the potential to 10x or go bankrupt within a year or two. They don't care. They're making so much profit, so much excess cash flow that they have the means to do that. And those other bets include a drone delivery service, they have an anti-aging health technology company, an industrial robotics factory, and much more. Unfortunately for Google, they are under a lot of litigation pressure right now because of their monopolistic behavior and practices. Hence, I don't think they're in the S tier, and I also don't think they're in the A tier. Because of everything that is going against them and how Wall Street is bearish towards them as well, I think Google is a solid B+. Now, if Google did not have so many pending and active court cases against them, they would easily be in the S tier. But I do live in reality. I'm grounded with the truth, and there's a lot of negativity in their way of life. I want to say that it's going to be a happy ending story for Google, but I cannot tell the future. So consequently, B+, even an A-, somewhere in between. Maybe like Apple, we'll put them like right there for now. I know it looks a little ugly, but maybe we'll clean it up at the end of the video and put them into their proper places. But anyways, the next company is another Mag 7. To round it out, the last of the 7 is going to be Meta, more commonly known as Facebook. I'm just going to call them Facebook, especially as someone who grew up with Facebook in the early 2000s. Now, this is the parent company of WhatsApp, Facebook, Instagram, and even within Facebook, you got Marketplace that has essentially made Craigslist obsolete, and they sell advertisements all over Facebook as well, just like Amazon. I think they're learning and stealing from the Google line of business where advertisements just print cash. High margins, super easy to do, and absolutely low overhead costs. Now, my only call out for Facebook is this. Their reality labs, it's holding them back from having the most perfect balance sheet known to man. And that's the business segment responsible for those VR headsets, the optics, and etc. Which is funny because I mean it when I say it. Their financials and numbers are absolutely delicious. A dividend compounder with cheese, no doubt in my mind. In fact, while I was researching Meta and making this video, I had to do a double take on almost every metric because my nipples were quite literally lactating at the sight of their numbers. I was like, dude, this is crazy. How are they posting these type of numbers? So consequently, I definitely think I understand why they're part of the Mag 7, and Meta is going to round out the Mag 7 by being in the S tier alongside with Amazon, and then Nvidia, remember, is an S-. So that's the Mag 7. And now we're going to move on to other very popular stocks that people like to talk about. And the first of the bunch is going to be McDonald's, the Golden Arches. So McDonald's is a real estate giant that just so happens to make burgers and quarter pounders. This channel loves McDonald's, by the way. And I think, well, after looking at their balance sheet and their numbers, they look fine. They're average. It's nothing out of this world, but it's a business operation that keeps winning decade after decade, despite the consumer trends, despite who is in the presidential office. McDonald's is here today and here tomorrow, and their dividend profile is quite juicy. So consequently, I definitely think McDonald's is in the B+ tier. I wouldn't go as far as to say they're A because their numbers are kind of stalling, just like Apple. It's kind of funny to see Tesla and McDonald's as a B+, and they're so opposite from one another. One is like a value investor's dream, and the other is like a very speculative growth company. But yeah, they're both a B+. As a matter of fact, let's tidy this up, okay? I think Apple, we'll put them right back down here. They're B+, and then Alphabet, also known as Google, they're a B+. So this right here constitutes the B tier. And the next business is the Walt Disney Company. And by the way, I made a mistake. I think we said and concluded that Apple is an A- or a B+, but I definitely think they're closer to an A- than they are a B+. So let's just shift everyone down this way. But anyways, the Walt Disney Company, ticker symbol DIS. They have the tools and the intellectual property to be absolutely successful and crushing it. But their mistakes of being political in their movies and their TV shows, it's just hurting them again and again. It's like they don't learn their lesson. You know, someone just putting their hand on a hot stove, burning it, and they're like, ow, that hurt. I'm going to do it again. Ow, that hurt. That's Disney. And the crazy thing is, their numbers and financials, they don't look half bad. It's just, there's a lot of negative sentiment surrounding this company. As a matter of fact, when you consider some of their most recent big movie releases, people were absolutely vocal on how stupid it is or how woke it is, and there's just a lot of negativity surrounding them, which is weird. Because historically, Disney is associated with positive vibes, and they're known to be the happiest place on earth, right? When we think about their amusement parks. What they're doing right now, I can't agree, right? When you become political with your business, you are literally dividing the customer base, and you're opting out of the other 50% of the revenue potential. But on that note of potential, I think they have a lot of it. So depending on which direction they go, are they going to choose to be creative and make original content instead of just remaking what they made 50 years ago and then being very political with their agenda in terms of their movies and franchises? Which direction are they going to go? They could either go into the D- tier or jump up into the A or B tier. However, as of right now, as it stands, despite all of the controversy and all of the hate and backlash that Disney is facing, I definitely think they're a C+. I think they're slightly above average as a company and as a business, but I can definitely see why some people would never ever want to invest into them because of how they keep shooting themselves in the foot. I get it. The next company is Target, also known as TARJ. Now listen, during the pandemic, they were an absolute Wall Street darling. Their stock price just shot up and went to the moon. But on the other side of the argument, when I took a look at their 20-year CAGR, year over year, we're talking about at 5.5%. However, like I said in the introduction of this video, that's the past. And that's because in the last 6 months, almost all of the gains that they acquired over the years just got absolutely wiped away. And I think the market is being very dramatic and they're just overreacting when it comes to Target, especially with their sell-off. Because at the end of the day, regardless of how you feel about Target, on paper, I think they're very high quality. And if they rebound and rally, of course their CAGR is going to jump right back up, in my opinion, right? It's going to be back up to like 10 or 11%. But as of right now, the facts don't lie, and it's a 5.5%. So as it stands, with everything that's going on with them, with their financials declining year over year, I definitely think Target is the prime example of what a C type of company looks like. Not C+, not a C-, but a very average company. But on that note, I want to say this. Listen, there's not many undervalued good opportunities in the stock market. I feel like everything is at an all-time high once again. But just like Dollar General last week, I think Target will be resilient. Meaning, if they improve their market position and stop playing the politics game, they should be a very solid B+ or even an A- retailer once again, just like Walmart or even Ulta Beauty. Now, that's not financial advice, but I definitely think that Target is beat up beyond belief, like to the point where it does not make sense. At least to me, it doesn't. So they're C as of right now, but I definitely think there is potential for them to rally back up and being normal once they overcome the drama that's surrounding them and all the boycotts and the political nonsense that the company executive and the marketing team, they need to go. I'm sorry if you're part of the marketing division at Target, but what are you guys thinking? Stop playing the political game. Just let your shoppers shop there without you putting in their faces a political agenda. Please. The next popular company that we're going to be talking about is Boeing. Now, every single time that I come around to giving them a chance, to giving them an honest look, another Boeing plane literally flies right out of the sky and crashes. Now, Between you and me, I think that's an absolute terrible tragedy for the people on those flights and their families. And it just sucks that it happens so freaking frequently. And I think for me, it's really relevant because I developed a fear of flying over some time in my adulthood. And to see and hear the news of planes literally flying out of the sky, it doesn't even matter if it's in a Western world country with their pilots or in a third world country, the planes literally just start malfunctioning or the parts are just not properly installed or faulty engineering. And it makes me nervous about flying. And I'm going to say this, okay, getting back on track. Out of the defense contractors like Northrop Grumman, Lockheed Martin, Huntington Ingalls, I think Boeing right now has pound for pound the most momentum and buzz because they were awarded by the Trump administration the F-47 jet contracts, which are going to be in the future replacing the F-16s, F-15s, and be more powerful than the F-35s. But the fact of the matter is, their financials, numbers, and data as of right now, it's really ugly. So freaking ugly. It's like when your wife first brought you home to meet her parents and her siblings, and her little sister was like, "Ew, Emily, why is he so ugly?" Like that type of hideous ugly, okay? Things are not looking too pretty for them. Although one could argue like their future is going to be bright again, but there's no proof in the pudding that things are going to get any better. Because when it comes to any other company going through all of the setbacks like Boeing is, they would have gone bankrupt. However, because Boeing is in such a specialized niche line of business of manufacturing commercial airplanes, I think that's what's saving them, right? Because the only other real player is Airbus, and that's a French company. And I highly doubt the American government is going to allow all of the American major airlines to buy their planes from a French company. So, because they have such an economic moat, despite sucking in their business operations and the way they treat their workers, just everything about this company, their financials, their employee satisfaction, and their products, everything sucks. But because they have such an economic moat and the backlog of orders is absolutely absurd, because you need to replace your fleet of planes if you want to be a successful airline. You can't have customer satisfaction if people are flying on Delta and it's a plane from 100 years ago, right? The seats are going to be all jacked up and the way that the aircraft handles turbulence is going to be piss poor and everything in between. That's why they have to replace their fleet. Who else can they do it through, right? It's Boeing. So that's why, despite having the most ugly everything, they're not in the F tier. As a matter of fact, I think Boeing is probably going to make a good case for what belongs in the E tier. Like, they're a dividend cutter. Did I say that? After taking a look at everything, there's nothing that makes me happy about this company. Nothing. Now, I will literally stick my hand in a Porta John's toilet and swish it all around with the blue liquid if you can prove to me right now, why is Boeing a dividend compounder with cheese? Because I concluded they're pretty disgusting. But the only thing saving them is their economic moat. That's my conclusion. Let me know. The next company is Uber. They're basically a taxi company, except they don't own the fleet of vehicles. Instead, they hire third-party contractors, 1099 employees, who use their own vehicle and put the miles on their cars. So they don't really have overhead costs. However, thinking about it, they have so much freaking competition, not just in North America, but abroad in South America, Asia, Europe. They're not the only ones doing what they do, right? There's a lot of ride apps, delivery apps, but I will give it to them, right? After looking at their 10K, the people seem to prefer Uber because they have the biggest market share, the biggest volume of transactions, and everybody else pales in comparison to their numbers. So when I think about their economic moat, I think it's their scale. Because if there's more drivers meeting the demands for more riders, then consequently it's going to be a better satisfaction for everybody involved because there's less wait times. But having said all of that, I just do not believe in their future. I think there's people out here that are absolutely bullish about them, and I think on paper it makes a lot of sense, but in terms of their catalyst and story and their future, I'm just not a believer. Because I think once Waymo, which was Google's autonomous driving technology and their cars, once it's fully GTM, because right now it's only launched in specific markets, once it's readily available all around North America and then worldwide, I think Uber is absolutely cooked. And I think Tesla is also trying to do what Waymo is doing. And not only that, I think Uber really reminds me of Airbnb. They're also along the lines of like, oh, look at us. We don't have much CapEx or overhead costs because we're just the middleman. We don't own the actual properties or the houses. They're just third-party contractors. And I get it, okay? The margins are there, the revenue is there, but if you take a look at Airbnb, look at how their fairy tale is panning out. I'll give it to them. At first, there was a lot of momentum, buzz, and hype, and people were raving about Airbnb. However, you fast forward a few years, and now most consumers are reverting back to just using a luxury or normal motel or hotel because of the ridiculous fees and requirements that are baked into your stay at an Airbnb. Like, why do I need to do the laundry, take out the trash, and paint the walls as someone who's paying to stay at your freaking little condo? Like, how does that make sense? And if I do all of that, why are you charging me an additional $150 cleaning fee to stay just one night, where that one night fee is $79.99? Make it make sense. It's stupid. But anyways, having said all of that, I definitely don't think Uber's as ugly as I painted out to be. I definitely think Uber is above average. And I think ultimately they're great as a C+. Not the worst company in the world, but absolutely far from being in the territory of Nvidia, Amazon, and Meta. So Uber, C+. The next company is Costco, the warehouse retailer. Now, with the numbers that they post, between you and me, I cannot justify their earnings multiple, their PE ratio. You know, everything looks pretty, okay? There's nothing that's ugly. I'll give it to them. But having said that, their numbers are slightly above average. It's not like Meta or Google's double-digit growth year over year. With Costco, we're talking about a mid-single digit number growth in their metrics. So when it comes to Costco, I definitely think the market is irrational. They're crazy, they're delusional, and people want to talk to me about how SCHD is a cult. Dude, I think when it comes to Costco and investing into them with a PE ratio of above 60 at $1,000 a share, dude, that's the definition of a cult. It doesn't make sense. So, having said all of that, after looking at the numbers, they are still a very juicy compounder, okay? It's just their valuation that I don't see eye to eye with. I think their grade is an A-. Okay, so they're going to be in the same territory and ballpark as the Max 7s, Microsoft, and Apple. Now, I'll say this right now. If they were trading at a multiple of like 20 or 25, their PE ratio being reasonable, then they would easily be in the S tier for me. But I just don't think you get good value from buying into Costco at $1,000 a share. It just doesn't make sense for my pea brain. The next company is Domino's. This is a pizza food restaurant chain franchisor. And they post numbers that are very similar to a tech company. Very good margins, stable cash flow, good financials, and the best part is, when I think about Domino's and pizza going forward, I like their future and their story. And their economic moat, I would argue, is the supply chain. Because of that, the distribution network of how they're able to get ingredients to their franchisees at a cheaper cost, that's what lowers the cost for the consumers as well. Everything taken into account, especially with their dividend profile, I think Domino's is a solid S tier company. Now that might be controversial, this might be a scandal, you might click dislike on this video, but pause it, open up a tab, and look them up. Their financials, fundamentals, and metrics, beautiful. Chef's kiss, Picasso. And to round out this list, the last company that we're going to be talking about is UnitedHealth Group. They were once a darling of Wall Street. However, in the past 365 days, they have since fallen out of favor with investors, Wall Street, hedge funds, and everybody. Despite them having a rock-solid balance sheet, it's like somebody taking like multiple Viagra pills at a retirement home. It is beautiful. Their financials are bulletproof beautiful. Like a 45-year-old woman who lives in Salt Lake City who has yet to do Botox on her forehead wrinkles. It is just beautiful. Now, I'm personally not a fan of the health insurance industry and their business practices of having actuaries, calculate and forecast the numbers so that they can deny life-saving treatments and operations for people that really need it. But as a potential investor, their margins, free cash flow, and dividend profile, it's too good to hate. And the crazy thing about UnitedHealth is you might be like, it's only recently that they've been crushing it. No, dude. You zoom back 10, 15, 20 years, they've been crushing it every single year. By the way, it's the exact same way that I feel about the tobacco industry. I really don't like what their products do to people, the addiction and everything. But when it comes to the stock market, you really do got to separate your personal feelings from winning businesses. And that's why as a dividend growth investor, despite me hating and despising Altria's business model, I still invest into them. They have a really good business operation. Their financials and dividend profile is just really beautiful. However, it's not a popular stock, and that's why it's not a part of this dialogue and video. But getting back on topic and thinking about UnitedHealth Group, I think there's going to be a lot of pending changes coming to the health insurance space that's going to reduce their margins going forward. Not to the point where they're not going to be a dividend compounder anymore, but instead of having like a 5% net margin like they do right now, I think in the near future, I'm talking about in the next 3 to 10 years, I think their net margin is going to be decreased down to 3%. Because now there's a lot of transparency and visibility on how they run their business model. And a lot of people, including politicians, are not a fan of UnitedHealth Group. I don't know if there's anybody out here that supports them like as a company. As an investor, it's a different scope. But as a business and how they deny claims, they have the highest claim rejection rate out of all of the health insurance providers. Bro, that's trash. But remember, that's my personal opinion, and it doesn't matter what our personal feelings or personal opinions are. On paper, I think it's still a dividend compounder with cheese. But because there's a lot of negativity surrounding them and pending legislative changes coming their way that are not going to be favorable for their business margins and operations, I think because of that, I had to knock them down. Initially, I decided they were in the A tier, but I think their near-term future is not going to be too pretty. So I think UnitedHealth Group is a B plus type of stock. Now, just like Target, I think UnitedHealth Group is a very good undervalued opportunity. And even though I hate them as a company, at the right price, I am willing to buy into them. If you want to know what that right price is, then subscribe to this channel because I'll upload that video next. That's not financial advice. It's just my personal game plan. So B plus. Okay? Now, if I had to elevate one of the 3 S tier companies to becoming S+++ and the champion out of all of the popular stocks, remember, Nvidia is not a part of that conversation. They're S-. So among Amazon, Meta, and Domino's, who would it be? To be honest with you, that's a really tough choice. I had to actually ponder and think and reflect about it while I was sitting on the toilet, like, which one would I go with? Because honestly, it's one of those few times in life where there's no wrong answer. Like if you're trying to decide on where to eat out for your birthday meal and your family is suggesting like the sushi place that just opened up, in your heart, you know the answer is always going to be Texas Roadhouse. That's the right answer. So in that case, there is a right and a wrong answer. But anyways, going back to who is the S+++ tier dividend compounder, well, I'm going to go with this company because of their dividend profile, their resilient business model, and the fact that they're buying back shares nonstop, and their financials look really pretty. Who do you think it's going to be? The key word there was dividend compounder, so it can't be Amazon, right? So for me, I think from a value investing, dividend growth mindset with low risk tolerance, the answer has to be Domino's Pizza. It's the kind of stock that you buy into and sleep well at night, knowing that your money is going to compound slowly over time. Despite all the market noise, despite everything else that happens, pizza as an industry and as a business, high margins and their future prospects look pretty darn good. But I will say this, if all I cared about was growth and total returns, then my answer changes, because then I don't think it's going to be Domino's, right? I think they have a modest CAGR at about, what is it? I take that back. I'm a dirty, filthy liar. The past 20 years, on average, Domino's CAGR is 20.8%. Can you imagine your portfolio's valuation growing at a rate of 20.8% year over year? Dude, that's fantastic. All that to say, this company, their CAGR is 27%. So if total returns is the name of the game, then I have to go with Amazon. Every single business segment that they are involved with has such a bright future, especially in my opinion, if they execute their growth plan without disruption from other startups and lawmakers. I think there's a lot of people that hate them and want to break them up. They think it's a monopoly. So they do also have some negative headwinds in their way, but they are a successful company that is crushing it. So the answer to who is S+++ It really depends on who you are and your risk tolerance. If you're anything like me, it's Domino's. If you're willing to stomach a little more volatility, then it's Amazon. So ultimately, my question to you is this: what do you think about my grades? Do you agree? Do you disagree? Is your hairline receding? Obviously, the answer is yes. And by the way, if you enjoy this content, you would love being a member of the Patreon family. That's not financial advice, but I'm telling you, you're gonna love being a part of the Patreon family. Now, if you want to hear my full pitch as to why Patreon makes sense for you, then please watch the video that's going to be linked in the pinned comment. Now, with that said, I love you guys. Stay safe. Good luck in the stock market. And Amos signing out. Peace.